Today, I'm joined by Arrowroot Family Office Director Dan Casey, as well as David Spencer, the blockchain accountant from DKS Spencer Tax and Consulting. And we're here to talk about blockchain, crypto, and this digital revolution that is shaping our future and the future of money itself. So let me go ahead and introduce Dan and our guest, David Spencer. Dan and David, welcome to the show.
Thanks for having me.
It's a pleasure to be here with you, gentlemen. Dan, good to see you again, and Roy as well.
Yeah. So I get started, and we always talk about origin stories and how you got to where you're at. So we talked off record here about how you guys got into blockchain. So Dan, why don't you go ahead and start out and give your origin story? Then I'll have David hop in and give our audience his background as well.
Yeah, for sure. And the audience will probably find it funny. David and I have similar origin, at least the backbone origin of our crypto endeavors. So I first read about Bitcoin in 2011 on a blog, randomly. I was in college, and my work study job, I'd worked some extra hours, had a little bit of cash, and I said, I need to do something with this. I'm going to be smart. And so I read about Bitcoin and said, that sounds like fake internet money. I'm not going to get swindled. And I opened up a savings account at Bank of America instead of Bitcoin. So that's where all of my regrets began. No, but then in 2015, I began to learn more about the technology behind it, learn how it was, starting to affect not just the financial industry, but come up with solutions for other worldly problems. And we've been diving in and research, and recently I just received my digital asset certificate in blockchain and crypto technologies.
All right. David, let's hear your pizza story.
So, much like Dan there, I was in college. When I was in college, I was a tutor. I was a mathematics tutor. And I was tutoring a guy in calculus at the University of Oregon, go Ducks, tutoring a guy in calculus, and he was a computer science major. So he starts telling me about this thing, Bitcoin, and he wants me to pay me for my services in Bitcoin. And it was kind of one of those things like the more somebody is trying to sell something to you, the more skeptical you get. And I was like, I don't know about this stuff, Bitcoin. I don't know about that, right? Funny money, right? And I said, pay me in cash. So it was a couple months later when I had done a little bit of research, I was like, oh man, what have I done? So like Dan, the regret of that first transaction or non-transaction kind of led me down the path to continue learning and educating. So we've been at it a while now here at DKS Tax, serving digital asset folks. And yeah, that's what we do every single day.
I love it. I love it. Well, there's an alternate universe where you guys are on yachts and you guys are Bitcoin billionaires, but we're here today and you guys get to grace our audience with some knowledge about tax and what's going on with crypto. So let's get started. And I want to hear your thoughts on President Biden's executive order on this potential watershed moment that's happening for the industry. What are your thoughts on what this is going to do moving forward? I know that this is just the start of regulation. We're doing research here on how best we can regulate it, create financial stability and innovation and guard against cybersecurity and all that stuff. So David, why don't you go ahead and start out and talk about what this means for the industry?
I'm as a person who is involved in compliance, this is a plus for me.
Yeah.
This is what we need, because until people have confidence in digital assets as an industry, until they feel that there will be someone there in case, the boat starts sinking, they're not going to get involved, right? And regulation can, whether it's good, bad, or indifferent at the moment, I'm glad to see regulation. The industry will lobby and get things that, are more beneficial and get things that work better, right? But that's going to happen over time. And as we grow and mature, that's going to happen. I'm glad to see that something is moving forward. So from a macro perspective, that's my thought. We can get into the details as we go, but big picture, I'm glad to see some regulation.
Yeah, David, I would have to agree. I mean, looking at the skepticism, that we both had when we first saw cryptocurrencies, right? And then pulling that lens back to your mom and pop, your local folks who maybe aren't in the digital world as much. It can be a very scary thing for them to say, oh, this is internet currency that I don't understand. It's decentralized, right? So we don't even know who created it. That's one of the biggest, concerns. Who even made this, right? Now with this kind of head nod to, wow, what a great innovation this blockchain technology and Bitcoin will be for our, not just our country, but the whole world is going to be groundbreaking stuff. And I really love that they're talking about, okay, we can create a US dollar stable coin, something that's stable and, with the framework of things like Bitcoin and some other, cryptocurrencies, aiding and stabilizing, against concerns like inflation or, like we've seen, in conflict, right? Having a place of store of value, right? For folks, hard-earned money and things along those lines. But like David said, we can get into the weeds very, very deep. I mean, this is like talking about the internet in 1998. What are the possibilities? Where are we going? There's so much to be spoken about.
Yeah.
And I think that analogy real quickly is so key. Talking about the internet in 1998 is definitely where we're at with blockchain. That's something I talk about often. There's a video of Katie Couric.
Yes, on the Today Show. What is the @ sign, right?
Yeah.
And it's so complicated to us now. Yeah. In 10 years, that's how we're going to feel about blockchain. A lot of the things that we use, we won't even know it's a blockchain thing. We'll just use it and it'll be cool. So definitely at the beginning of a whole new world.
Yeah, I agree here. So let's kind of dive in. I want to give some tips here, David and Dan, about how to deal with taxes here, because I know there's questions that come up. So we have a list of 5 items here that I'd like you guys to discuss. The first one being, taking care to identify dates that you've bought crypto and when you sell it. So can we talk about number 1 here in regards to taxes?
Yeah, so that's my life right now. And what we are doing is reconciling transactions. The most important thing in the practice of doing it is knowing where all your assets are.
Yeah.
Oftentimes, digital assets investors are moving so fast. They're trying to do different projects. They don't know where all their assets are.
I got a friend with 10 screens in his place, and I go, how do you keep track of everything?
It's amazing. And so definitely making sure that you keep good records is huge. And don't lose your passwords. I was actually on a call with a client earlier. So this is a stamping machine that you use to stamp the password on a hardware wallet, like a piece of steel. So that way you don't lose the password. So an important thing to think about, keep good records.
Yes, those records, so important. Passwords. I mean, at the office, we joke, we can't wait until retinal scans are the only thing we have to do, right? Because there's so many passwords to remember. But when we're talking about your cryptocurrencies and stuff, not just having passwords, memorized and whatnot, but also having them stored in safe places, whether that's a safety deposit box or a safe somewhere in your home or on another property, whatever it might be, however you want to do that. Don't keep everything in one place, right? You got to kind of spread things around. Now, with the identifying the dates you acquired crypto and sold, now for fast movers, day trading crypto and getting in and out of projects, that is something you need to have some due diligence about. For those folks who want to get involved and they might, buy and sell, but they stay, within a few select holdings, one thing to aid in your entire tracking system is the fact that everything is on a ledger, right? There are ways for you to look at and see the list of timely transactions, because that's what the blockchain does. It creates a ledger for transactions and it's verifiable. So you can look at the historicals of your transactions, whether it's on Coinbase or another platform, and you can, dive deep into the code and figure out what's going on.
Yeah. It's so powerful. And once accountants really start understanding it, they're like fall in love. So we just completed our first audit over here at DKS Tax and Consulting for blockchain.
Congratulations.
Very much. Thank you very much. And the I'm dealing with an auditor who had no idea about crypto. So we teamed up on it. And I help her with the crypto piece. She's got the auditing style, pull it together. It was awesome. And she's like, how are we going to verify this? I just don't even know. This is blockchain. How do we know about this Bitcoin? And she was very worried. But for me, I was like, the verification of the Bitcoin is the easiest part.
Yeah, that's what the blockchain is.
That's all it is. And so once I showed her, she was like, really? Like, why do people think that's hard? And so it was just such an eye-opening experience to see someone who really looks at, Etherscan is where you can go and see everything on the blockchain. If you've got the address and you go to Etherscan, trying to verify anything is a breeze. And so really good point.
Yeah.
The question is it hard or is it just new? Right.
All right, let's go to number 2 here. A big tax loophole for crypto losses. Dan, I know you can talk about this, the wash sale rule, rebuying stocks within 30 days. This isn't applied to crypto just yet. Not that it can't be retroactive here.
Right.
Can you kind of talk about this tax loophole?
So considerations in this is, the reason the wash sale isn't applying yet, because trust me, Congress is like, how are we going to tie this knot?
Yeah.
The reason it's not applying yet is because they're not viewing cryptocurrencies as securities, right? They're not considered that yet. They've had a few go to, review under the SEC and be determined such, but the majority are not. So they're looking at it more, from a property standpoint, I guess David, that'd probably be the best analogy I could give.
Correct. Yeah.
And so, you're allowed to, sell out of, your crypto and buy it right back. And, there's no 30-day wash sale. None of that will apply. So it's a very unique time. Like we said, we're pretty early on this stuff. So there is some loophole opportunities if you are in a situation, where there's losses or gains that you'd like to offset.
The wash, first of all, he's absolutely correct, right? There's not a whole lot to add to that. But take advantage of it while we can, because it could go away.
It will go away. Yeah, we'll go away.
What time
is
it?
It went away. All right, let's move on to number 3 here. Let's talk about avoiding or minimizing the tax on airdrops. So, David, why don't you talk about what an airdrop is, and then we're going to discuss how to avoid or minimize the tax on it.
So an airdrop is when you receive a digital asset that you weren't expecting. You could be expecting it, right? You could also be expecting it, but an airdrop is one that you didn't purchase, right? So generally speaking, when you receive a digital asset, you had to trade it for some other asset, right? Cash or something else. An airdrop is usually a marketing technique in which a company gives you some form of a digital asset in hopes that you will then use it and create traction for the asset, right? It can also be a scam, right? Yeah. So if you do have a randomly in a wallet and you get a random set of tokens, don't click on it. Don't do anything with it. That's the first thing, right? Because it might be a scam. If you're expecting it, then let's talk about the tax consequences, all right? So first thing, it's income when received, right? If the problem often is that there may not be a quoted price for the asset. People are giving it away. So how do you find the price of that asset? That's what we often have to do on a regular basis, is kind of track down that price and keep good records. Because eventually the best case scenario is that the asset appreciates wildly. And now you've got a huge gain that you've got to calculate, and you've got to have some kind of record of the basis. Often that will be zero if it was worthless when you received it. Now, what if you get one that's a scam and you don't want it? It very likely is best not to click on it. The clicking on it is very likely going to open up the can of worms. So I do like to tell people about that when it comes to taxation of airdrops. Yeah. Additionally, if it's something you don't want, you can also get rid of it, right? If once you've confirmed that it's something that you did expect, you can get rid of it by burning it, sending it to a burned address. That effectively gives it away, right? So if you received it, it was $10 and you didn't want it, you burned it, you lost $10. It's gone now. It's a wash.
Yeah, absolutely. I mean, there's not a ton I can add there. I would just say, as far as receiving airdrops, if you say, or if you receive a message on Twitter or Instagram or whatever it might be saying, you've been selected to receive $10,000 in Ethereum, it's probably not real.
Yeah.
It's not. Nobody's doing that. Nobody's just giving away thousands and thousands of dollars. Now, if you're in a part of a community and you're, working together, on different projects and sharing ideas and airdropping to expand exposure and knowledge of certain projects, sure. But there's a level of due diligence. I would recommend talking to a professional and showing them whatever message you've received for verification, even if you say, I've been talking to this person, for a year and a half on Twitter or whatever. I trust them. It's good to do a little extra legwork.
Great. All right, let's move on to the next topic here, maximizing deductions from mining. So let's just give a brief definition of what mining is, and then, the taxes that are required to be paid on the fair market value of the coins when received. David, so can you start out and give our audience a breakdown?
Mining. So we're going to talk about nodes a little bit later. So I'll give you both of them real quickly.
Right.
So mining refers to proof of work networks. Okay. So Bitcoin and Ethereum are both proof of work networks in which a computer is solving a very complicated mathematical puzzle. And that's the work that it's doing. Right. And when you do that, there are costs associated with mining digital assets, right? The cost of the computer, the cost of the electricity, the cost of the know-how. So there's costs associated with it, okay? Nodes are second generation blockchains, and they don't have as high of electricity requirements. And so that's why they're a little bit more friendly, environmentally friendly. Mm-hmm. Effectively, technologically very similar, but the work being done there is verifying transactions. So maximizing those deductions kind of goes back to number one, keeping good records. Do you think that's about right, Dan?
Yeah, I think it's records, right? And use the ledger. The ledger is your friend. With, as far as the nodes and proof of work being basically the race to solve the problem, right? It's a math competition, between the computers, versus, what we're talking about with nodes, which we'll talk about staking as well, which is kind of the go between, it's proof of work, proof of stake. We'll get into that. But when you're maximizing those deductions from mining, it's all about tracking everything that you're doing, right? Use the ledger to keep good records, because that's going to allot you the greatest amount of information to, deduct as much as possible.
Yeah, can we kind of talk about that, the long-term and short-term gains, and also the income? I know you have the candy bar machine analogy, David. I think it's a great way to visualize on how someone can get taxed. Can we talk about that? Because I think it's a good foundation for us to discuss later topics.
Excellent. So the candy bar analogy. So the idea behind the candy bar analogy talks about if I'm earning income from a machine that's producing a thing, right? So if I've got a node, it is a machine that is producing a product that I can then sell, or an asset that I can then sell. So if I have a candy bar machine and it pumps out candy bars all day, every day, pumps out candy bars, I don't pay tax on those candy bars until I sell them, right? So that's a pretty standard treatment. We're familiar with that treatment. Up until this point, digital assets have had a very different treatment. As the machine, the node or the mining machine, produces the tokens or candy bars, to analogize, I've been taxed on those at the value at the time they are received. So it's income at the time it received. That's very different than the candy bars. So at current, the IRS has had a question about that, right? And they have currently punted. Right?
They punted.
They punted on that question.
Kicking the can down the road.
Yeah, later on we'll get a decision. So at the moment, clients and are taking varied levels of aggressiveness on the position. So we'll see how it plays out. There will be some litigation about when staking rewards are taxable within the next coming years.
Yeah. I mean, do you maybe want to touch on the three buckets that you have clients kind of viewing this type of situation, David?
Yeah. So The first is the most conservative approach, which says it's income at the time it's received, we'll pay the tax, and then we'll see what happens at the end once we get more clear guidance, right? The most aggressive position is we are going to take the position that we are not going to pay the tax until we sell it, and then we will pay the tax on the income that is sold, right? On the incomes generated from selling the items, we pay tax on that. But the tokens held in treasury, we don't pay tax on that. In the middle, there's a middle ground where taxpayers are income when received, they pay the tax on that income, and then they request a refund, right? When we say that the IRS punted, what they actually said is, here, just take the refund, we'll talk about it later, right? So you pay the tax, then you request a refund under these grounds, and the IRS is still thinking about it like, here, just take the money back and we'll have a decision for you at a later date. So that's where we're at on that question.
Right.
Great. And I know we touched on staking and the environmental concerns. Dan, I'd love to hear, I know you gave the analogy of the NBA lottery or NBA draft. Can you touch on staking?
So let's talk about staking. So we're talking about proof of work, right? We talked about that. It's the race to solve a math problem. Staking is vying for the opportunity to solve that math problem. And what I mean by that is people are going to say whatever cryptocurrency blockchain we're talking about, they're going to buy a certain amount of that, and then they become staking eligible. So what that means is they basically are ponying up and saying, I'm not going to sell this. I'd like the opportunity to participate on the network as a problem solver, as a miner, whatever it might be, owning a node. And so they're staking that liquidity. Now, the more you own, the better your chances of coming in first place. So it kind of works like the NBA lottery. Well, in the NBA, the more losses
the opposite,
yeah. Right. So instead of acquiring losses, we're acquiring whatever that cryptocurrency is to have the best odds.
Yeah.
Now, if say, the big concern was like, well, I could just buy all as much as I can, and then I'll just get first every time because I have the most. Well, no, once you solve the problem, you go back to the
line. Yeah.
And when you're back there, you can then, you can't pony up any more of what you've already staked, but you can buy more and stake more to move up the list from the bottom and gain priority. So you have to invest more into that, staking, whatever that cryptocurrency might be. So what it does is, one of the big things it does is helps with the environmental concerns that were surrounding Bitcoin. This proof of work process where you have, at first it wasn't a big deal, but now that we have basically factories and warehouses full of mining computers that are burning energy at such a high clip, that's a huge concern. If you have 30,000 of those all over the world running at once, that's a lot of energy. That's a lot of, burning. With proof of stake, only one of those 30,000 gets to run, theoretically, if it's all on, the same cryptocurrency. Only one's running at a time. So therein lies a huge solution and a huge reduction in energy use. Now we can get into, countries looking into using volcanic energy to, make things run so it's completely renewable and all the rest of it. There's huge layers to this, right?
Yeah.
But what that staking has opened up is node ownership, which I think we'd like to touch on next. And node ownership, being, I call it the blockchain Airbnb.
Airbnb.
Right? It's you stake enough into whatever that cryptocurrency, blockchain platform might be. You buy enough, and then you package it and say, I want a node. And then you own a node, and then which would be a
property, right?
Yeah. It's like owning a rental property.
Yeah.
And you can rent, basically rent out your problem solving node to whoever wants to utilize the blockchain, and you receive a reward for that, similar to a dividend paid daily, right? So it's quite the interesting piece to this where, and one of the tax concerns that's popped up that I wanted to talk to David about, and I was excited to hear, is, okay, so what does that mean tax-wise if I I own the cryptocurrency, so there's capital appreciation potentially or losses. I am staking it, so I'm receiving rewards for solving those problems, but I also have a node and I'm receiving a dividend off that, right? Or a payment off of that for people using it. So that's 3 layers of capital growth or loss that we're dealing with, and how are those going to be taxed?
So great question, right? So that's what we talk about all day over here. Now, could be talking about 2 or 3 different parties, because oftentimes those are 2 or 3 different parties to separate that. And why? Blockchain is complicated. It is complex, and not everyone desires the time, has the time to learn it and manage their nodes. So if I buy a node, right, there's a number of ways that can be done. Either I can physically purchase a very expensive computer that requires me to have a robust internet, robust electricity, right? So that's a serious financial undertaking and an investment, right? So that is one way to own a node, right? Mm-hmm. And once you have that, then you can rent it out like the Airbnb, right? And it will also produce rewards and all of that. I see less of that. Generally, the people who buy the physical machine, they like to rent it out to other people and they collect that income really nice.
Right.
Because people want that as a service. They want someone else to take care of that expensive machine.
Hardware, yeah.
Okay.
Right.
So now you're paying someone else to run the machine for you, and they process the rewards and give them to you, right? So you do have the capital appreciation piece still, and you do have the rewards piece. You just don't have the part where you're paying somebody else. Now that is an expense. That's part of your monthly expense for operating your node. Mm-hmm. Okay. Which is a positive, because if your node does well, you're going to want some expenses to offset the income. Right? So the node ownership can go a number of different ways, and it's really exciting. It's really exciting for people to get an opportunity to grow that way.
Oh, absolutely. And important to note that you don't have to buy the tower. Like, you can buy the tower. It's a great way to do it, but there are ways to own digital nodes. There's ways to do this completely on your computer, right?
Yeah.
You don't have to create a physical space. So there's so much an opportunity there. And, one of the big things that I'm a fan of with it is that the expansion of the blockchain, right? So just on a foundational level, blockchain is able to, in theory, verify truth, verify, truth of transactions, right? That, one party has the goods, the other party has the funds, and we can make this thing go. And, having that neutral third party observer, if you will, on the blockchain solving that transaction is huge. Because think about, we talked about the internet in 1998. Think about how nervous you would have been spending over $100 on eBay in 1998.
Oh my gosh.
Whatever. You think about that.
Putting your credit card to buy something on the internet. Oh,
I don't think my father put his credit card online until 2 years ago.
Yeah.
So you think about, these things are huge concerns, right? There's trust, and adding this trust authentication is just a huge layer to make world commerce function at a higher, a higher capacity.
Yeah.
So
speaking about trust and verification and rewards, I know, Dan, you want to talk about this participant rewards, and I think there's this company called Veracity, if I'm not mistaken, where you can, you're invited to. Well, so let me repeat that again. Let's talk about rewards here and participation and verification. Dan, I know there's that company Veracity that you're talking to me about, and I'd love to have you tell our audience, and I'd love to hear David's thoughts on the tax implications of this, about the future of participation, from being the content creator to the viewer to the miner. Can you talk about this application of Veracity, and maybe give an analogy on how it would be used by a creator and a viewer?
Yeah, absolutely. So let me start from the root of it and the discovery of it, right? One of the big issues that happens in advertising generally in our multimedia spaces, and I only know this because my wife works for advertising for Spotify. So she's, kind of told me, yeah, well, there's a big issue out there. And the big issue is false views, right? Fake views. They say it's $160 billion a year in fake, revenue lost to fake views and fake credit to users and on media. So we're talking about what they call view farms. They're warehouses where iPhones, like
I've actually seen pictures of them. It's crazy. There's just iPhones upon iPhones.
Yep. And
in
they
a
just
warehouse.
play the same video or the same song, and artists or media player, people who want to pump their views and get trending and all that will pay these folks to just kind of,
and talk about that model, Dan, if you can, how YouTube works and how they reward as far as advertising dollars to content creators.
Right. So YouTube at say it's at 1 million views starts to pay you, right? You start to get revenue, share in the ad revenue from those views. Well, if you are interested in making money off of your content, it would definitely incentivize you, to take a portion of your pie, your revenue pie, and pay these farms to pump your views so that your pie gets bigger, right? You make more money. And it's a siphoning of these advertising dollars. And what it does is it hurts the advertisers' spend, right? Because they're not getting the views and the impressions that they think they are, because nobody's watching that video. It's just playing, on a loop. So that's a huge, concern for a lot of advertisers, a lot of, your Spotify's, your YouTube's, your Netflix, the list goes on, on and on and on down the list. What the big thing with Veracity is they're looking to utilize the blockchain to have viewership verification. So think about, all right, so let's say LeBron James, right? LeBron, hugely famous, known all over the world. He makes, everybody has wanted him to be in the dunk contest for years, and he makes his own dunk contest demonstration video and shows all the cool dunks he can do. Well, if he puts that on YouTube, he's going to get millions of hits, right? But, how do we know all of those viewers? How do we know there's no churning going on, right? How do we know that all those viewers are viewing that content and being directed to, whatever it is, whether it's a Nike advertisement or whoever's advertising on the platform? Well, what Veracity does is everyone on the platform, there's a content creator, so LeBron, there's a viewer, me, I would watch a LeBron dunk highlight for sure.
Me too.
And then there is the person running the node or behind the blockchain who's solving that transaction. So the transaction between the content creator and, the viewer. And there's, on this Veracity platform, when it's implemented behind a Spotify, behind a YouTube, whichever it is, everybody gets a reward once the view is complete. So instead of, you only get paid when you get to 1 million views, you get paid per view, and they can determine how much. So the miner gets paid for verifying the transaction. The content creator gets a reward, a payment for their content getting viewed, right? Per view. And then the viewer, for verifying themselves as authentic and unique, gets a kickback as well. They get a reward as well. So now we have this ecosystem where everything is verifiable, right? Solves a $160 billion problem. So, David, my question is, how do we get taxed on that $160 billion?
When that's an awesome system, first thing, because we've seen these farms. This isn't the first time we've heard about this question. And what we're actually talking about is what blockchain can do. So it's beyond, my analogy is always Facebook is the internet as Bitcoin is to blockchain, right? Sure. The internet's more important than Facebook, and the blockchain is more important than any one digital asset, right? And so we're seeing an application of the blockchain that's outside of just a coin goes up or down, right? And that's important because that's utility, okay? So that's the first thing. So we love to see that. We need to see new industries, new businesses, right? Yeah. And how we get taxed on it is always going to depend on which chair you're sitting in, because there's 3 different parties there, right? Mm-hmm. So as a node operator, we've discussed that a little bit. Income when received depends on how aggressive you want to be with that income.
Those 3 buckets.
Right? So those 3 buckets on how aggressive you want to be. I think for the individual, it's going to be pretty straightforward. You got a payment that's in cash. We know what we have a market level input for whatever that token is, or if it's a USDC or whatever it is. And
third one's the viewer, the the rewards.
It's a reward. And then for the company, it's an expense, right? So it's something that's going to go on their books as an expense. And the service is going to love all of that because it's going to be on the blockchain.
Right. Now, David,
easy to see.
So David, as the viewer, and I asked this because, so if I am operating on that platform still, and I haven't taken that payment, say I leave it in whatever the coin is, right? And it's still on there, kind of like having Xbox dollars or whatever, whatever that might be. Before taking that and converting it back into US dollars and bringing it home to the bank or whatever it might be, while it's still resting on that platform, what are the implications there for taxes?
Yeah, because you're going to have a capital gains event. Right? If that token goes up or down, I mean, that's why I said capital gain. It's a capital, gain or loss, really, because it could go up or down. If you receive the token and it's, $100 per token, just to put a number on it, and then it goes up to 150, then you do have a $50, you have the $100 in income when you received it, and then the $50 when you sold it, right? So that is a double taxation. People don't like that, right? So they don't like to hear that is the case. But the fact of the matter is you did receive $150.
Right.
Right. So we do got to report that, accurately. And there's so much happening in the digital asset space. I always share with clients, our goal is to accurately represent the economics of the situation.
Right.
If we do that, then you can sleep good at night, right?
Yeah.
And that's what it's about, right? We don't want people to be worrying about taxes all day. We want them to be out on their new boat they bought from the digital asset world, enjoying their life, not worrying about if the IRS is going to pull up next to them.
Right.
Yeah.
Right.
And speaking of the long-term capital gains, short-term, long-term capital gains and how we're taxed, I know we talked about that application, Dan, what was it called? Strong on the node ownership. I know you gave some numbers here, which I thought were fascinating. Can you kind of go into those particulars?
So not to endorse this in any way, but just as an example, right? So if you were to own, and this is not a physical node ownership, this is, digital. So if you were to own the company that, we've heard of Strong, Time, David shared a couple before we got on the call.
Pocket.
Pocket. So essentially, let's say you have to own 10 Strong to have a node. So you have to buy 10. Say it's trading at $400 per coin, right? So I buy it's a $4,000 investment. And now I own one node. And then I put it out there and people can use my node and I get a reward daily, right? So those 10 are staked into my node, right? That's what creates the node. You then have to have, a certain amount of, it operates on the Ethereum network. So you have to have a certain amount of Ethereum to cover gas fees, which we can get into another time. That's a whole rabbit hole. But basically, think of it like, I want to buy a stock. It's a $5 commission, right? Think of it similarly to that. Once that, is all set up and structured, then you're going to receive a payment for people utilizing your node daily, right? And it's normally 10% of the value of the Strong. So we're talking about 10% dividend daily. That's, and at $400 per, it's $40 a day, which is a $4,000 investment that creates about a $13,000 dividend, if you will, or reward each year. So that's pretty significant. That's a large, amount, but like David said, there's tax implications here. So you have income tax, do you have capital gains? How does this, kind of shake out when you have numbers like this? Does it add to cost basis?
It adds up quick too, right? So once people kind of learn about it, they're usually very skeptical. Like, well, huh? Yeah. $4,000 investment, a $14,000 return in 365 days. Yeah. But that's really what's happening. And it's just because we're at the beginning of this new industry, right? And it takes a little bit of knowledge to think about, to know what you're doing and to navigate it. So definitely have some due diligence when you do it. But you have to pay expenses, right? You've got expenses for those. So make sure if you've got any expenses associated with operating your node, that you keep good records. We talked about that, right? And think about it like a business, right? This is a business, right? It's an investment that you make. It's something that you do have to actively think about and manage, right? So that's what I give people when I think about it, because it's a business. You're going to pay taxes on it. You're going to have expenses, and treat it as such.
Right.
Yeah.
Right.
Great. Yeah, we're just at the beginning here. And I think we're in the beginning of doing this on a more frequent basis. This was very insightful, guys. I really appreciate it. I know we've been asked by a number of different people on providing more content on blockchain and crypto. So I appreciate both you coming on the show, and I look forward to having you guys on in the future. Dan, do you want to give any ways people can potentially contact you?
Yeah, so I'm at the Arrowroot family offices, Dan at arrowrootfamilyoffice.com. Feel free to shoot me an email if you have any interest in learning more about this, getting started investing in this. I've got a great tax guide for it named David. So, if anybody wants to, get in touch and start going through this year, I'll be doing presentations on foundations of blockchain, how it's operating, how it could impact sectors and industries and things like that outside of the tax world a little bit. But great if you have clients who are interested, who are entrepreneurs or interested in business or are exposed to certain things. I mean, there was a great, even just recently, David, I'm sure you saw in the Harvard Business Review, they implemented a private blockchain in Walmart in Canada, and for their third-party freighting, took errors and omissions from 70% down to less than 1%. Make goods from 2 to 3 months down to 2 to 3 days, saving millions and millions of dollars and providing more service to everyone across the country. So this stuff is coming. It's already being implemented behind closed doors privately. So if you have clients or people that that may find some interest, please reach out. We're happy to help get them started.
Yeah. All right, David. And then what's the best way for our audience to get in contact with you?
The easiest way is probably to Google us, DCAS Tax and Consulting. We're available, dcastax.com. You can send me an email, david.spencer@dcastax.com. And what we do is serve digital asset investors in their businesses. The majority of our clients are folks who have invested in digital assets, changed their lives, and now they're trying to figure out what's next, right? How do I diversify my portfolio? How do I rebalance, right? And so we take care of their tax needs. That's one part of it. And the next thing is what's happening next, what's going to happen next in the industry, and that's the consulting. So it's DCAS Tax and Consulting.
I love it. David, Dan, thank you so much for coming on the show. We're going to do this again in the future. So I hope you guys have a wonderful day, and we'll talk to you again.
Thanks so much, guys.
Thanks. Bye.
All opinions expressed by Rob Santos and Rory Henry on this website podcast interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.